The true innovation of Alfred Winslow Jones was not a mere trading strategy, but the creation of an entirely new, sophisticated financial architecture designed for absolute returns. Born a journalist and sociologist, Jones entered the world of finance in the post-World War II environment, a period ripe for structural disruption. Traditional investment vehicles were often constrained by rigid regulatory frameworks and focused predominantly on long-only strategies tied to the whims of the broader market. Jones recognized that true financial mastery required a structure capable of profiting regardless of whether the overall market was rising or falling. This insight led him to establish his first partnership in 1949, fundamentally altering the landscape of wealth management forever. Jones did far more than simply pair long bets with short sales. He engineered a revolutionary financial vehicle defined by four specific, interconnected pillars. These pillars included sophisticated hedging mechanics, the calculated application of leverage, a radical compensation structure based on performance, and a comprehensive research system utilizing non-traditional inputs. Together, these elements formed the complete integrated investment system that became the foundational blueprint for the modern hedge fund industry. Understanding Jones requires moving beyond the basic definition of long and short positions and appreciating the structural genius behind his enterprise. He sought to create a mechanism that systematically isolated stock-specific success from systemic market risk, thereby delivering a smoother, more predictable stream of returns to his investors. The term hedged fund, which Jones himself coined, originally carried a distinctly defensive connotation, emphasizing risk mitigation above all else. In the prevailing market environment of the late 1940s, institutional investors were primarily worried about protecting capital during downturns. The hedge component was intended as an insurance policy, guaranteeing that the portfolio's value would not collapse entirely if the general economic tide turned negative. This focus on defense allowed the fund to take aggressive positions on individual securities without exposing the entire capital base to systemic shocks. It was this dual mandate, aggressive pursuit of alpha coupled with rigorous systematic risk management, that defined the novelty of his creation. The original term highlighted the protection afforded by the short book, rather than the aggressive return generation potential that later defined the industry. The first critical pillar of the Jones system was, naturally, the mechanics of hedging, which established the foundational principle of separating market risk from managerial skill. The classic Jones model, implemented starting in 1949, involved the simultaneous holding of long positions in stocks expected to rise and short positions in stocks anticipated to decline. For every dollar invested on the long side, a corresponding fraction of a dollar was typically dedicated to shorting stocks, creating a partially market-neutral posture. This careful pairing of opposing bets ensured that the fund's performance was theoretically less dependent on the overall movement of the Dow Jones Industrial Average or the Standard & Poor's Index. The goal was to generate returns based purely on the manager's ability to select superior stocks and identify weak, overvalued companies. Risk mitigation through pairing served as the primary psychological and mathematical justification for the entire endeavor. By maintaining a short book, Jones effectively created an internal insurance mechanism against broad market declines, which represents systematic risk. If the entire market dropped by 10%, the short positions would appreciate in value, offsetting a significant portion of the losses incurred by the long portfolio. This protective mechanism allowed the fund to withstand periods of macroeconomic uncertainty far better than traditional long-only mutual funds. The short side was thus deployed not primarily for profit maximization, but specifically for volatility reduction and capital preservation during widespread downturns. The specific goal of this sophisticated balancing act was the achievement of absolute returns, regardless of overall market direction. Jones aimed to isolate stock-specific alpha, known as idiosyncratic risk, which is the risk unique to a particular security. By hedging away the systematic risk, beta, the fund's performance became a purer measure of the manager's stock-picking acumen. If the manager correctly identified a strong stock and a weak stock, the difference in their performance, the alpha, would accrue to the fund, independent of market movements. This pursuit of absolute rather than relative returns fundamentally distinguished Jones's approach from the common practice of benchmarking against an index. This focus shifted the metric of success from beating the market to simply making money consistently. While the long and short foundation was essential, the move to outperformance required the introduction of the second critical pillar, leverage and amplification. Jones realized that simply maintaining a market-neutral portfolio, where long and short positions were roughly equal, would only yield moderate risk-adjusted returns. The critical decision that moved his system beyond mere neutrality was the calculated application of leverage, directed almost exclusively toward the long side of the portfolio. This strategic use of borrowed capital allowed the fund to magnify its exposure to the stocks in which Jones held the highest conviction. The role of borrowed capital was to act as a powerful catalyst for alpha generation. Transforming a defensive structure into an offensive powerhouse, Jones utilized margin and other forms of borrowed capital to increase the size of his long book well beyond the assets contributed by his limited partners. For instance, a fund with $100 million in capital might deploy $150 million on the long side, while simultaneously maintaining a $50 million short book. This structure meant the fund was net long by $100 million, but the total exposure was $200 million, amplifying potential profits from the perceived winning stocks. Analyzing how Jones used this capital reveals a calculated risk, leveraging his highest conviction bets while using the short book to stabilize the overall structure against market volatility. The combination of leveraged long positions, offense, and unleveraged or conservatively managed short positions, defense, became the true engine of profit for his fund. The short book functioned as the ballast, protecting the capital base from systemic risk and providing liquidity if needed. Meanwhile, the leveraged long positions capitalized dramatically on correct stock selection, turning a small positive performance difference into a substantial return on equity. This structural setup explains why Jones's funds often delivered superior returns during bull markets, while still offering protection during bear markets. It was the dynamic interplay between the two sides, amplified by judicious leverage, that defined the system's success. To legally facilitate this strategic use of leverage and maintain the necessary privacy, the limited partnership structure was structurally detailed and essential. By organizing as a private partnership, Jones's fund was exempt from many of the regulatory constraints imposed on public mutual funds, particularly those related to the use of margin. This privacy also meant that the fund was not required to disclose its strategies or holdings publicly, giving Jones a significant competitive edge. The limited partnership structure also defined the relationship between the general partner, Jones, the manager, and the limited partners, the investors, setting the stage for the revolutionary compensation model. This legal framework was as crucial to the system as the financial mechanics themselves. The third pillar, the architecture of compensation, represented a radical departure from standard Wall Street practices and was crucial for aligning the interests of the manager and the investor. Traditional investment managers typically charged a simple percentage of assets under management, regardless of performance. Jones introduced the revolutionary 2 and 20 fee structure, a 2% management fee charged on assets, and a 20% performance fee levied on profits. While the 2% fee covered operating costs and provided a stable income base, the true incentive lay entirely within the 20% performance fee. This 20% performance fee was absolutely crucial to the complete system because it fundamentally incentivized managers to seek absolute returns, not merely relative returns against an index. Under the old model, a manager could charge fees even if the portfolio lost 5% while the index lost 10%, claiming relative success. Jones's structure demanded that the manager generate actual positive profits before earning their substantial bonus. This direct link between manager compensation and investor success ensured an unparalleled alignment of interests, pushing Jones and his team to prioritize capital preservation and aggressive alpha generation simultaneously. The structure demanded excellence and accountability in a way traditional finance did not. To further enforce accountability and ensure fairness, early hedge funds often implemented high watermarks or similar carry-forward clauses. A high watermark dictates that the manager can only charge the performance fee on net new profits that exceed the fund's previous highest valuation. For example, if the fund loses money one year, the manager must first recover all those losses before they can charge the 20% performance fee again. This mechanism protected investors from paying performance fees repeatedly on the same recovered capital, ensuring fees were only paid on genuine incremental wealth creation. The high water mark solidified the performance fee as a true reward for success, rather than a guaranteed annual bonus. This fee structure fundamentally changed the risk tolerance and operational mindset of the fund manager. Since a significant portion of their potential wealth was tied to the performance fee, managers were highly motivated to deploy capital efficiently and manage downside risk meticulously. The high watermark specifically discouraged overly aggressive, reckless behavior, as a severe loss could lock the manager out of performance fees for years. This architecture of compensation was not just a business model, it was a sophisticated risk management tool woven into the very fabric of the fund's operation. It established a standard of performance-based pay that would eventually permeate the entire alternative investment sphere. The fourth foundational pillar of Alfred Jones's system involved a comprehensive, almost sociological approach to research, moving beyond the traditional fundamental analysis prevalent on Wall Street. Jones, with his background as a journalist and sociologist, understood that market inefficiencies often stemmed from behavioral biases and structural shifts, not just discounted cash flow statements. His methodology incorporated quantitative screens alongside deep qualitative and sociological research into investment decisions. This integrated approach allowed the fund to identify trends and shifts long before they were reflected in consensus financial reporting. Jones deliberately sought out non-traditional analysts, including sociologists, mathematicians, and engineers, to staff his research teams. These individuals brought diverse perspectives, capable of identifying emerging trends and market inefficiencies that traditional finance analysts might overlook. For example, a sociologist might assess shifts in consumer behavior or demographic trends, providing an early signal for long bets on companies poised to benefit from societal change. Conversely, quantitative analysts used early computing power to screen for statistically weak companies that were ripe for shorting, basing decisions on metrics beyond simple price-to-earnings ratios. A crucial component of this research system was the macroeconomic overlay, which informed the directional bets, specifically the highly leveraged long exposure. While the short book remained focused primarily on specific failing companies, idiosyncratic risk, the decision of how much leverage to apply to the long side was often guided by global or large-scale economic forecasts. If Jones anticipated a period of strong economic expansion, he might increase the net long exposure and apply higher leverage to capitalize on the rising tide. Conversely, if recession loomed, leverage might be reduced, and the short book might be expanded to achieve a more neutral stance. This dynamic macroeconomic sensitivity ensured that the system remained flexible and adaptable to changing market cycles. The research was not static. It was a continuous loop of quantitative screening, sociological trend analysis, and macro forecasting, all feeding into the tactical deployment of capital. This comprehensive research mandate required broad diversification across many stocks to ensure that the alpha generated by the leveraged long book was not wiped out by a single short-side failure. Diversification minimized the risk associated with relying on any single piece of research, reinforcing the system's inherent focus on risk-adjusted returns. The diversification mandate was a non-negotiable component of the operational framework, ensuring portfolio robustness. By holding a large number of long positions and a diverse set of short positions, Jones mitigated the catastrophic risk associated with concentrated bets. If one of the leveraged long positions failed, or one of the short positions unexpectedly soared, the impact on the overall portfolio would be limited. This structure allowed the fund to benefit from the law of large numbers, where the average success of many small, well-researched bets outweighed the volatility of any individual stock. The complete research system, encompassing both the analytical tools and the operational constraints like diversification, ensured that the fund's success was systematic, not accidental. It formalized the process of searching for alpha across multiple dimensions: fundamental weakness, quantitative signals, and sociological momentum. This integration of diverse research inputs provided a durable competitive advantage that was difficult for traditional investment houses to replicate quickly. The commitment to a multidisciplinary team was arguably as revolutionary as the fee structure itself. As we synthesize the elements of this groundbreaking structure, we understand that Alfred Jones created the first true modern hedge fund by combining these four pillars: hedging, leverage, performance fees, and quantitative research into a single cohesive entity. The hedging component provided the stability and the insulation from systemic risk that defined the vehicle's defensive capabilities. The calculated application of leverage provided the necessary engine for generating supernormal returns, transforming mere stability into aggressive profit potential. These mechanical elements were supported and driven by the revolutionary performance fee structure, which ensured that the interests of the manager and the investor were tightly bound together. Finally, the sophisticated multidisciplinary research system provided the intellectual fuel, ensuring that the capital was deployed based on rigorous analysis rather than mere speculation. Each pillar reinforced the others. The fee structure encouraged better research, the research informed the leverage decisions, and the leverage amplified the results of successful hedging. Jones's system was not merely about stock picking. It was about creating a vehicle optimized for maximizing risk, adjusted absolute returns over the long term. This structural optimization is what truly sets his contribution apart from his contemporaries. The investment innovation was thus the vehicle itself, a limited partnership specifically designed to operate outside the constraints of traditional finance, prioritizing performance over conformity. Jones essentially decoupled the return stream from the market cycle, offering investors a product that promised consistent growth regardless of the economic environment. This ability to deliver alpha with controlled beta was the ultimate value proposition, appealing directly to sophisticated investors seeking diversification away from conventional asset classes. The hedge fund became synonymous with the pursuit of uncorrelated returns, a concept pioneered entirely by Jones's integrated model. The enduring legacy of Alfred Jones is not just the invention of the long-short strategy, which many preceded him in using sporadically, but the creation of the complete integrated system. This architecture of finance became the blueprint for the entire alternative investment industry that followed, spawning thousands of funds managing trillions of dollars globally. Every modern hedge fund, regardless of its specific strategy, owes its structural existence, its limited partnership format, its performance-based fee structure, and its freedom to use leverage and short selling to Jones's initial design. His work proved that superior returns could be achieved through structural innovation as much as through superior stock selection. This sophisticated system fundamentally changed how wealth was managed for high-net-worth individuals and institutions, opening the door to complex strategies previously unavailable. Jones demonstrated that financial engineering, combined with rigorous, multifaceted research, could consistently yield superior, risk-adjusted outcomes. His integrated model remains a powerful testament to the idea that structure and incentives are just as important as market intuition in the pursuit of financial mastery. The enduring power of Jones's structure lies in its inherent adaptability, allowing managers to scale complex strategies while maintaining strict risk controls. By institutionalizing the management of idiosyncratic and systematic risk separately, Jones provided a framework that could be applied across various asset classes and market conditions. The initial concept of the hedged fund may have evolved, but its core DNA, the pursuit of absolute returns driven by performance fees and structural freedom, remains completely intact. This historical analysis confirms that true financial innovation often resides in the operational and structural design, not just the momentary trading decision.